Welcome, my favorite federal employee. I'm Andrew McNair, son of a CSRS employee, founder of SWAN Capital, a total wealth management company where we have financial planners, estate planning attorney, and CPAs all serving retiring federal employees just like yourself. So today we're diving into the top 7 mistakes to avoid with your TSP so you don't find yourself in a tough spot down the road. So let's jump right in.
All right. So first of all, what's the problem with staying with the default TSP settings, Andrew?
Yes, the TSP has default fund allocations that are a really good starting point, but may not be the best long-term option. And so I would encourage you, as the first TSP no-no, is don't start with the starting point where they put you in at the TSP at the beginning of your career. So many federal employees stay too conservative early on when a heavier mix of CS&I or one of those TSP funds way later in retirement, like TSP 2050, for a longer period could be way more beneficial. Default contribution rates also start at 5%, which is great if you get the full government match, but it may not be enough to have the early retirement or cover those unexpected expenses that you may have in retirement. So again, if you start with 5%, don't let that be where you end up. You want to actually push that contribution up every year. Every time you get a new step raise, you get a new promotion, you want to look at increasing that contribution until you get up to 20% of your gross income, or a good approach would be at least 10% right off the start. So as retirement approaches, life cycle funds shift to conservative investments too quickly, in my humble opinion, heavily weighing you into G and F funds, which may not be ideal for every retiree.
Okay, makes sense. Makes a lot of sense. Now, who should federal employees get their advice from regarding their TSP? Who should they be careful about getting it from, I should say?
This is the second TSP no-no, is be careful who you take advice from. And this is really important because there's so many water cooler experts. We call them barracks lawyers if you're in the military. There's many well-meaning people in your office that offer financial advice, but not all are qualified or experienced in federal retirement planning. You know, you may have Joe at the water cooler who seems like the subject matter expert on your federal benefits, but remember, they might have just got lucky. Even if they've already retired, they may have just literally got lucky. And so they only have to worry about one retirement. When we've helped hundreds of families retire, it's important to use tested in the trenches advice. So the first person you want to watch out for is those water cooler experts, colleagues who seem confident but have only retired once, meaning they have limited experience beyond their own situation. Number 2 is you have to be aware of things like YouTube channels. Even this one right here, you should vet all the things that you're hearing. Watch out for TSP newsletters and federal newsletters. Some content creators are just that. They're just content creators. They've never actually helped anyone retire, and may have only retired once, if it retired at all. So many content creators and writers may not be licensed to give financial advice, and they won't be held accountable for wrong advice. And so I think the big reality check is that taking advice means that you're trading place with the person that is giving it. Be sure that you're comfortable with their financial situation because it might be what you're inheriting.
Right. Yeah, exactly. I mean, their situation isn't the same as yours, so you do have to be careful. Now, what's the risk of investing too conservatively in your TSP, Andrew?
Yeah, I always put it like this with clients is you don't want to drive a minivan on the Autobahn. You want to drive something fast and fun and like a convertible. And don't limit your TSP potential in the same way. Investing like your emergency fund isn't instead of a long-term retirement plan can limit your TSP's potential. So many families are putting what belongs in a money market, a savings account, a CD, but they're acting like their TSP is that emergency vehicle. No, I mean, your retirement is not to be touched until your retirement age, until you're fully retired. And so the common age 100 rule, which is subtracting your age from 100 to determine how much you should have in C, S, and I, or a stock percentage, is a general guideline, but it doesn't apply perfectly to everyone. So for example, for all my Leos out there, the law enforcement officers, they may be retiring retiring at 52, for example, they may need a more conservative approach because they're going to be retiring sooner. So if they're 3 years out from retirement, normally at 52, you would still have plenty of runway where you could take more risk. But it depends not so much your age, but when you plan to retire. Because I do have clients that retire at 52 and 72. Now, while a 60-year-old who's planning to work all the way until they're 72, they have 12 more years before they're going to have to access their TSP. So they should be taking more risk and they don't have to be so conservative. So don't make the mistake of sitting too heavily in G and F funds, feeling safe, but they don't protect you against inflation. And that is one of the biggest concerns for retirees long-term is going to be inflation. So your TSP needs to have that growth potential to keep up with rising costs. Also, please avoid day trading your TSP, jumping between G and C funds, going back and forth based on short-term market swings actually can increase your risk and lower your long-term returns. The economists and the statisticians have proven this over and over again.
But Andrew, there are dangers in taking on too much risk with your TSP, right?
Absolutely. This is the opposite part. I always like to say, don't drive your Lamborghini in the school zone. It's not meant to do that. Some federal employees panic and they think they need to quote unquote catch up by taking on excessive risk. You know who else has to catch up when they're down? Gamblers. That's who does that kind of catch up as well. So exposure or overexposure to the C fund when the market is booming, people may often pile into a fund like the C fund when it's doing really well. Well, you're probably a little too late and you're going to be in an aggressive mix. So you have to watch out for things like black swan events, these unpredictable market crashes like a COVID that can wipe out gains and force you to work longer to recover. And the sad mistake is a lot of people say, it's always come back. It has, but in the United States it has, but it hasn't always in every economy. And every time we always say, well, it's going to be just like how it's always was, is not always the case. I mean, look at the Nikkei, the Japanese stock market took like 20 years to recover. So what we help clients do is build an investment policy statement. So this gives you a defined strategy for 1 year, 3 years, 5 years, 10 years out from retirement, instead of just going based on age. The other thing I encourage you to do is stress test your TSP. This is where we can take really good financial planning software that we just didn't have 20 years ago and make sure that you feel comfortable showing you in a 2008, if your balance dropped 20%, 30%, or 40%, would you be able to stomach? So again, a 20% loss on $1 million TSP balance means losing $200,000. We often use like percentages, but our brain doesn't always do a good job of translating that to actual loss. So I encourage you, when someone says 20% loss, well, on $1 million, that's 200,000 real dollars. And so many people underestimate their real risk tolerance. The next thing I would encourage you to do is stop over monitoring. Checking your TSP daily doesn't earn you extra points. Like when you log into TSP, they don't give you extra credit points and actually put money into your account because you log in so often. Warren Buffett's advice is so sound. Would you invest in a stock that you couldn't check the price on for 10 years? And the same applies to your TSP. Would you put money in the S fund or the C fund if you didn't know the share price for 10 years? So you don't make 20-year decisions based on 20-minute emotions.
Wow, great points there. Now tell us why it's so important to double check our beneficiaries with the TSP.
Yes, this was a big snafu on the TSP's part. TSP really blew it when they actually erased thousands of federal employees' beneficiaries. And I always tell people, like, imagine if Chase or Wells Fargo or one of these large brokerage firms lost thousands of their clients' beneficiaries and had to actually start fresh again. I mean, there would be a class action lawsuit. But no one was really taken to task when that happened for TSP. And I actually just ran across this yesterday, Luann, where someone had a $689,000 TSP and he had no beneficiaries listed. Not his spouse, not his kids, nobody. So it's very important to make sure that you double check on your beneficiaries. So many employees either don't have beneficiaries listed or they have outdated ones. Your TSP to beneficiary designation is going to override your will and your trust. Probate courts won't honor your last will and testament over your TSP paperwork. That TSP is going to take precedent. So please, check your annual TSP statement to confirm that both you have a primary and a contingent beneficiary and that they're up to date and they match your wishes. So you want to make sure you have a plan A, a plan B, and maybe even a plan C, a tertiary beneficiary. So please do avoid those common mistakes like listing an ex-spouse, forgetting to update after a marriage or birth, or leaving it blank completely.
So, Andrew, why should our TSP allocations match our long-term investment strategies?
Well, I mean, many federal employees have their current allocations in C, S, and I, but their new contributions are going into L income or the G fund without even realizing it. So it's really important, and this is one of those TSP no-nos, is syncing up your future contributions to your current allocations, unless there's a very good reason. So many federal employees make this mistake where their contributions and their allocations are going in different directions. And this is a mismatch problem. If your existing balance is long-term focused, but your new contributions are too conservative, it dilutes your growth potential. So the best practice is keep your future contributions aligned with your investment strategy. One exception to artificially manipulate this would be during a market downturn. So some federal employees may choose to temporarily direct their new contributions into more aggressive, more into C, more into S, and more into I, while the market is, again, sadly undervalued or has had a pullback, and this is the time to capitalize on it.
So we've been going over the top mistakes to avoid with your TSP. What should we do if we've made some of these mistakes?
Well, I mean, first off, don't panic. I mean, these mistakes are common. That's why I'm recording this video, so that you don't make these TSP no-nos. And they can be fixed. Many of these are not forever problems. They're not set in stone. We can change and fix them. The key is in recognizing and adjusting them before they become bigger and bigger problems. I do consider it a really good opportunity to say, hey, if any of these TSP no-nos apply, this is the perfect time to get that comprehensive benefit report. This is where we're going to, one of my financial planners in my office or myself is going to put together a report to look over your survivor benefit option, your FEGLI option, your TSP allocations, as well as help you decide on what you should do about a FEGLI, for example. Like, should you take a reduction before you retire? These are all very good questions, but without a report to go through all the details that's customized to you, this is the difference, is you can get a lot of general information from some of our videos and you'll have more knowledge, but you necessarily won't have more wisdom. Wisdom is the application of this knowledge. Now, if you have federal retirement questions, please do email us at the address below so that maybe one of your questions becomes one of the topics that we discuss here on our channel. So do give us a call at 1-800-848-8768 for that personalized federal retirement report. I hope you have a blessed day, and we'll see you next time.